What's going on, guys? You know how to make a follow-up video. If we're gonna talk about the NEOS buying the below inception price, well, I'm gonna have to talk about another income ETF that is my favorite. But before I get started, legal disclaimer before we start though, this content is for informational and educational purpose only. It should never be considered financial investment or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed on my own. It may be inaccurate or complete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, guys, I am just a random idiot you found on YouTube, and I could be completely wrong. All right, with that out the way, guys, I have to talk about this one because it is pretty underrated. It's pretty well known, but it's pretty underrated when it comes to the NAV growth and the high yield income space. All right, we're going to be talking about the part 2 of the income trap versus the tactical edge. All right, again, the market is completely mispricing two different options overlay philosophies. Okay, these are great pairs together. Yes, you can say, oh, it's the market overlay and it's just overlapping. But remember, you're buying different strategies. Okay, all right, let's get started. All right, so the core thesis is income reset versus growth reclaim. Okay, so like in my previous video, right, NEOS monetizes volatility for immediate income, but in doing so, it structurally sacrifices your future upside. Right, come in. Look, my favorite, the Goldman Sachs boys, all right, uses a partial override discipline to reclaim the exact upside when the regime flips. Okay, the real trade isn't income versus growth, is knowing exactly when to own each. And again, guys, it is best to own both, right? Not financial advice, but it is best to own both. Like I said, remember, if you're new to the income space, right, new to the channel, I've mentioned this, I've created a post about this, I've created a video about this, right? The Goldman Sachs boys has beaten every other NEOS, what was it, T Alpha, JEPI, Roundhill, right? They came out on top year to date for total returns, right? This is the reason why. Because they do a partial override. So that strategy absolutely dominates when the market flips back to a bull market. All right, so let's talk about the behavioral mispricing, right? The 12% yield illusion, right? So of course you have to stop chasing vanity metrics, right? I constantly see a lot of retail investors chasing double-digit yields while entirely ignoring total return, right? This creates what we call the income trap, right? This is the dangerous illusion that a 12% yield is a victory, right? In reality, your total return is negative if the underlying erodes by 13% to pay you. You are sacrificing your long-term compounding just for immediate psychological comfort. Okay, so why does a 100% override fail? Okay, for those who are new, of course, you're not going to know about this, but for those who are not new, all right, you can go ahead and skip ahead, but a quick rundown. A traditional 100% override ETF do not fail in crashes. They fail in rebounds, okay? Equity returns are asymmetric, meaning massive long-term gains happen on a few highly aggressive trading days. Legacy funds systematically sell away these exact explosive days. So when the market drops, your NAV drops, but when the market rebounds, your upside is permanently capped. Okay, the recovery problem, right? This is split into two. I'm going to talk about the QYLD example, but first, cannibalizing principle. If your fund massive distribution is bigger than its capped economic return, right, it is forced to cannibalize its own principal to pay you, right? So over multiple market cycles, this triggers what we call a structural lag compounding, right? Slowly liquidating your portfolio. The best example of this is the QYLD example. Okay, this is a legacy funds that have experienced 3 to 4% NAV decline annually for this exact reason, right? You miss the strong upside days that drive real long-term equity returns. All right, so enter NEOS and SPY QQY. Okay, so let's look at NEOS, right, which uses a consistently high override ratio engineered to extract maximum premium, but instead of naked calls, they deploy a net credit ladder call spread using a European style cash settled index option. Okay, so they sell a call closer to the money but buy a out of the money call to act as a structural collar, the credit spread, right? So if the market aggressively melts up, well, your upside is uncapped beyond that long strike, restoring some convexity. This is why you have some NAV growth here. Right, NEOS duration and tax advantage. Well, we all know about the active rolling part of the strategy. NEOS actively roll options daily or weekly to adapt to shift and avoid severe 30-day decay, delta decay, right? And of course, they're well known for the Section 1256, right? Of course, this is why people love them. They are very, very tax advantage and tax friendly with a 60% long term and 40% short term capital gain, right? This leads to massive savings, right? So in the top bracket, which we all should be aiming for, right? All of us should be aiming for the top bracket, whether you're planning to be single, no kids, you're gonna retire somewhere, and enjoy life somewhere, and your only goal is 50, 60K. You want aim for a little bit more, okay? This cut your tax rate to 26.8%. This is the blended rate, so it saves you anywhere from 10.2K to $100,000 per $100,000 in income. So it's a lot of money. All right, so constructive return of capital. Okay, I just want to put this data here. In 2024, 93.91% of SPY's distribution and 95.8% of QQI's distribution were classified as return of capital. This is the constructive advantage. Because payouts were funded by option premiums rather than liquidating principal, this is completely constructive rock. Don't let anybody else tell you it is not, okay? They're idiots, right? So what does it mean? Of course, it allows you to defer taxes on the sale of the asset while maintaining pure NAV stability, right? But enter Goldman Sachs, GPIX, and GPIQ, okay? These two are the absolute foundation of my portfolio, and I hope everybody starts realizing that you need to have these two in your portfolio if you are a long-term long-term income investor. These two, I mean, it's sad that it gets passed up because of its yield or whatever the reason it might be. And a lot of people, I do see that they're not happy with the yield, but this is why they can survive long term. Okay, the tactical delta modulation. Okay, what I mean by this is that they do a very specific strategy. They entirely reject the full override model. Instead, the coverage is dynamically modulated with a strict range of 25% to 75% of your portfolio's notional value. So by leaving up to 75% of the portfolio unhedged, Goldman explicitly guarantees unrestricted linear participation in market rallies, and this is why they have dominated in 2025. This override ratio is generally reset monthly, triggered primarily by market volatility signals. Okay, so this kind of somewhat semi rule based / of course active management based, right? So this is the good, but what is the bad? There's always some trade-off, right? So internal mitigation here. Goldman writes co-options directly tracking ETFs utilizing standard and customized flex options. Okay, so this means their premiums are fundamentally taxed at 100% short-term gains or ordinary income. The verdict for this, well, of course, you can always offset this inefficiency. Okay, Goldman relies on aggressive internal tax loss harvesting and ETF redemptions to flush out low basis holding. So if you have a tax advantage account, of course, Goldman's higher total return via beta capture often wins here. Okay, so this is part of the it may not have the best tax advantage here. But you're gonna say, well, they also use Section 1256, so they aren't really known for it, but they do have some tax advantage. But NEOS does take the cake and does take the win for extreme return of capital and the Section 1256. Right, so let's do a structural head-to-head. Okay, we're comparing NEOS to Goldman, two titans, two tier 1, and you can see, of course, in a taxable account, NEOS offers a more elite, mathematically superior tax profile. Of course, a higher yield, also a little bit more aggressive, right? But Goldman does win in the expense ratio, which offers a better lower drag over long term. And On this channel and myself, right, I'm in my early 30s. I plan to hold these for the next 30, 40, 50 years, however long I live, okay? So these do matter to me. Okay, the green regime, right? So let's talk about the VIX being under 18. Well, in a grinding low VIX bull market, opportunity cost is your primary performance drag here, okay? So in 2024, Goldman's algorithms dialed GPIX override ratio down, right? So capturing nearly 86% of the S&P 500's upside, okay? This is why GPIX delivered a massive total return, a NAV return of 21.77% for the year, easily outperformed SPY's 19%. You may go, I'm gonna hear it. Oh, it's only 2%. That's fine. Well, if it does this consistently, 2%, like myself, I'm in my early 30s, over 30, 40 years makes a difference. 1%, 2%, 3%, those make a difference over the course of 30, 40 years, 50 years, right? So I'm at my early 30s. Hopefully I live a long life, maybe until my 80s or 90s. That is another 40, 50 years I got, right? So, guys, this matters a lot, okay? Don't think, oh, it's just 1 or 2%. It's fine. No, no, no. Well, unless you're 60, 65, 70, 75, you might not care for that. It's only 10 years and maybe perhaps you're single, no kids. Okay, I get it. But let's talk about the general sense. I'm pretty sure I have a pretty young audience, that are around my own peers, my own, the late 20s or early 30s, like myself, some in the 40s, right? We're still considered the peers, right? We do care about these percentages, okay? It matters. So this allows Goldman's coverage ceiling mathematically dictates at least 25% of your portfolio always participates linearly in a recovery. This is great. This is why I love it. This is why I always stress in the comments when you go, I'd rather prefer this. I'm like, why don't you guys, especially if you're starting out, take a look at the Goldman bros, okay? GPIX and GPIQ, in my opinion, is probably one of the most best, consistent, reliable, and the most important, sustainable. Okay, they don't offer these crazy yields, right? 8 to 11, 12% yields, depending on GPIQ and GPIX, which is 1% a month. If they can't do 1% a month, there's trouble here, right? These are hedge funds here. 1% a month is all we're asking for. All right, high volatility and crashes. Okay, so let's talk about how they handle a crash buffer. So when volatility spikes and market crashes, both strategies absorb equity losses. But let's compare it to NEOS. NEOS high octane premium collection acts as a better massive buffer by a few percentage. Of course, it does make the difference. Okay, active harvesting. So in a peer crash, SPY's active daily and weekly rolling allows it to harvest inflating premiums all the way down. This is why it does a little bit better of the buffer here. Defensive scaling, right? So meanwhile, Goldman will defensively scale its override towards the 75% maximum boundary to protect your capital. This is where I think the Goldman Bros does better defensively, preparing itself to go into the offense when the market rebounds. And they have shown this since inception. Okay, recoveries in choppy markets. So what happens in a V-shaped recovery, right? SPY's 73% upside capture historically trails GPIX 86% and sometimes towards 90% capture during a strong rebound. However, okay, SPY's daily rolling mechanism prevents the fund from getting permanently trapped and deep in the money calls. Okay, this is why you see SPY and QQI really capture the V-shaped recovery quite well also, right? So this is recovering faster than the legacy 100% overwrites. Well, how do they perform in a sideways market? So in a range-bound market where capital appreciation stalls, SPY and QQI structurally dominate here, okay? So due to their sheer premium extraction power, they effortlessly out-yield, of course, right? They have a higher yield here, GPIX and GPIQ by 300 to 400 basis points annually. Of course, they have the higher yield here, right? They're a lot more aggressive. Okay, so when does NEOS underperform? Well, in my opinion, in a relentless multi-year low volatility bull market like 2007 or mid 2024, don't say that doesn't happen. These years can happen, okay? Don't think these good times last forever. Absolutely not. Okay, I'm telling you that from an investor like myself who's been doing this for years. Okay, I've been doing this for a long time now. Don't think a lost decade cannot happen. It can and it will happen at some point. The market resets. It's a whole cycle. It will happen. So the high nominal coverage requires to sustain a 12% yield acts as a severe structural drag in this environment, right? The fund will significantly lag peer index funds, of course, and tactical overrides like Goldman Sachs, right? It essentially caps out at roughly 73% upside capture, right? So you are leaving a more massive growth on the table here. So when does Goldman underperform? Right? I talk about the good and the bad, right? About everything. I own these. I own all of these. I don't think I'm just here trashing one another. I own them all. Okay. Goldman will bleed during prolonged, choppy sideways markets with elevated baseline volatility. Okay. Understand, there's very key wording here. Okay, because Goldman prioritized preserving upside beta. If the market trade flat for 2 years, right, GPIX will essentially return 0% on capital appreciation. Okay, you are left solely with the 8.5% yield. Okay, so in this exact scenario, SPY's more aggressive premium harvesting will significantly outperform on a total return basis. Guys, this is why I say you need to own both, right? They play around each other. I get this a lot from the comment section. Oh, but it's just overlay on the same thing, same index and the same, holdings. Guys, you're buying the strategy, buy the structural mechanism behind this. You're not buying because, it does the same thing on the same index. No. This is the wrong mindset here. Absolutely wrong mindset. Do not do that. You're buying the strategy, right? All right, regime rotation strategy. So how does it perform on a grain VIX under 18? Well, low IV means cheap premiums. So overweight GPIX and GPIQ to capture 86% of the upside while yielding a nice big fat 8%. Well, in the yellow zone, when the VIX is 18 to 32, right, this is expanding volatility. So inflates premium. I would say overweight more at SPY QQI to lock in a solid 12 to 14% yield, shielded by the tax efficiency. In the red, when the VIX is over 32, this is severe distress, right? Heavy on SPY and QQI allocations allow you to harvest extreme panic premiums to offset underlying equity decay. But this is where I forget to put, you should be dumping money into GPIQ and GPIX. This is for when the VIX end up turning green again, right? When the fear goes away, this is when the market rebounds and you see the capture going back up. This is where you buy essentially a growth, like GPIX and GPIQ is the growth stock, right? So understand, this is 1, 2, 3. The market resets. 1, 2, 3. The market resets. As you can see, this is why I'm saying, guys, you need to buy both, right? They're playing off each other. All right, the future of income investing. I just want to state this, right? The next evolution of income investing isn't about raw yield. It never was, right? It was always about structural flexibility and regime adaptability. This is why these two play around each other so well. One is more the aggressive yield harvesting to get you paid, and one is more, hey, let's focus on the growth first, pay you out later, right? But we are more about going in line with the market, okay? Remember, legacy 100% override funds are effectively obsolete. They acting as a slow motion wealth destroyer in bull markets, right? NEOS has engineered the ultimate tax advantage income for choppy or volatility regime here. All right, timing the trade. So, of course, I just want to put this out there again for modern fiduciary. Your ultimate edge lies in recognizing the regime, right? Understand Goldman compounds capital in expansion, while NEOS defend and distributes capital efficiency during volatility. So by dynamically rotating between the two based on the VIX threshold, right, you can finally recoup high yield from NAV destruction, right? It's like they play around each other. They're kind of like the red and blue team, right? One goes in, the other stays back. The other goes in, the other stays back. It's perfect rebounding off each other. Right, so hope you guys got something out of this. I had to make a part 2, and I had to talk about buying, great cover call ETFs under the inception price, because you know what, Goldman deserves a lot of love, and It definitely deserves a lot of love in my portfolio, and I definitely do give it a lot of love. So again, guys, I hope you got something out of this video. The next video should be something spicy and something well, not spicy, but something good. I found another stock I do want to talk about that I might have to break my 2026 promise and actually put some money into this, because I'm really liking it. But stay tuned for that. Thanks for watching. Again, if you're new, you found my channel, help my channel grow, help the algorithm, give me subscribe, comment, like, and drop a comment below. What is your favorite strategy if you had to pick one, NEOS or Goldman? Thanks for watching. Stay tuned. Catch you guys on the next.